September housing data eyed after disappointment there. Um, that figure, let me see when it's going to come out here. The National Association of Home Builders Index there of housing has risen more than 4.6%. This is from Reuters so far this year. It has fallen 3.6%. Last year, that was 6.4%. The index fell 9.9% from September 16th to September 29th. Labor Department holiday, well, we won't get into that one, but that index is, as they say, not going as well as we would want. We'll take a quick look at the National Association of Home Builders and get that figure here. If they don't have any new figures out, they will be getting out a new figure very shortly as their reports. We usually normally, should say, use their figures, and they will come out. I think it's next week. Housing Market Index through September. Just looking at it here, and we'll put this in our show notes. And we'll see exactly where we are. See if we can grab. We got some forecasts here. We'll see where we're going with this. This is their spreadsheet. Well, anyway, we'll come back to this at a much a later date. We'll go now to the BBC and their report, checking to see if there was any new, as one would say, business headlines coming up here, other than the chair of United Airlines had a heart attack. That is not as noteworthy as one can be. On the other end of it, weak Barbie doll sales hit Mattel's results there, and Nestle still has the Megan noodles fallout still going on there with them. We reported on that before, and won't actually go back into it there, but we did have some results from the markets that were basically strong. The Fed, incidentally, while we focused a little on the IMF, one of the big items here, consumer sentiment. We need to report this. The University of Michigan's Consumer Sentiment Index rose to 92.1 in early October from a reading of 87.2. The survey current conditions and sub-index has shot up to 106.7 this month from 102 there. So in other words, it has we've seen some changes in consumers, but weak industrial output slipped to 0.2%. That was from the Federal Reserve. Weakness in oil and gas drilling dropped 1% in August. Industrial production rose an annual of 1.8% there. Manufacturing accounts for 12% of the U.S. economy. This is from Reuters. Third quarter growth estimates are currently about 1.5%. Slow growth, low inflation there. Manufacturing output fell 0.1%, and mining fell 2%. That's oil and gas wells there, and 60% plunge in oil price since June of 2014. Schamberger has had some problems there, and utility production increased 1.3 in September, and This is kind of a little survey here of what is going on out in the oil fields, and some of the related companies have had problems. Schnauberger has had its problems, no doubt about that. And let me just take a very quick look at this. The index, this is from the University of Michigan, at 92.1. Current economic conditions at 106.7. Index of expectation, we got this because at 82.7 from Dr. Curtin. He is the director, the chief economist. Rebound in confidence signifies that consumers have concluded that the fears expressed on Wall Street did not extend to Main Street. Importantly, renewal confidence did not simply represent a relief rally, but instead a reflection of renewed optimism. Personal finance expectation, excuse me, rose to a level to their highest level since 2007, as prior to the Depression, as did the consumer's view towards purchase of durable goods. While consumers anticipate continual economic expansion, many expect strong headwinds from falling commodity prices, weaker economies in China and elsewhere, as well as continual stress on the European countries. Perhaps the most important finding is that low inflation and continual job growth has enabled consumers to adopt a slower and more variable rate of economic growth by varying the pace of their spending without losing confidence that the expansion will come. Overall, the data indicates that consumers will expand at 2.9% during 2016. Very important here. This is preliminary for October. This is one of the things we wanted to highlight. We'll go ahead and do the numbers from the markets now and see exactly where we are. These are Fridays unless otherwise noted. The FTSE was at 15.70. In Amsterdam they were at 4.12. This is at 4.16. The DAC was down 57.49. In Paris they were at 27.50. In Brussels 25.99. In Madrid 129.80. In Zurich 62.38 on Friday. In Moscow they were down 24.47. In Johannesburg they were also down 294.82. In Bombay they were at 204.46. In Karachi 33.02, or not 2. In Lahore they were down 2.93. In Colombo they were also down 9.71. And in Tehran on Wednesday 538.90. In Sydney 38.10. The Nikkei was 194.90. Hong Kong, the Hang Seng was at 179.20. In Shanghai they were 53.28. In New York they were 74.22. And the Nasdaq was at 16.59. And the Merck, that's the commodities market out in the Midwest city of Chicago, at 9.25. And in Sao Paulo 74.96. And in Mexico 276.57. On to commodities. Brent crude was up 76 cents at $50.49 a spot. was up $1.33 at $50.02. West Texas crude also rose 46 cents at $47.26. T-Boone Pickers jumping for joy. He remembers $15 a barrel. Oil. Cocoa was also up $15. Coffee was down $7.85. Gold, this is a Forex index, was down $7 at $1,176.35. Dubai gold futures was up $19.40 at $1,185. Silver, for those wishing to know, was down 14 cents at $16.04. And finally, on the Euronext Life futures, cocoa was up $13. Robusta coffee was down $21. And white sugar futures was down $1.40, which is good for you. The Bloomberg Commodity Index was down negative 0.06 at $86.74 for the Bloomberg Index. And that will do it for us. For those in business, have a productive next week. For the consumer, keep your eyes on the prize, as indicated by the index from the people at the University of Michigan and the comments by Dr. Curtin. Good day.
Good afternoon, all of you. I would like to thank President Humala, Minister Segura, Governor Velarde, and the people of Peru for hosting us. Also, thank you, Managing Director Christine Lagarde, for working so effectively with the membership. We had very productive discussions today. Let me review them briefly. On the global economy, as you can see from the communique, we agreed the global recovery is continuing. That is the good news, but growth remains modest and uneven, and key policy priorities, it was agreed, must focus on lifting short-term and potential growth, preserving fiscal sustainability, reducing unemployment, managing financial stability risks, and supporting trade. This may seem like a large task. However, we are not starting from scratch, and the ministers and governors broadly affirmed that continued policy adjustment and implementation is necessary because uncertainty and financial market volatility have increased and medium-term growth prospects have weakened. We all recognize there is no room for complacency. Emerging market and developing countries are generally better prepared than earlier for this less favorable environment given their stronger fundamentals, buffers, and policy frameworks. That is also the good news. Nevertheless, many emerging market economies are exposed to tighter financing conditions, slowing capital inflows, and currency pressures. A sustained recovery in the euro area, growth in Japan, and continued robust activity in the US and the UK were viewed positively. However, spillovers from increased market volatility is mentioned in the communique because they may pose financial stability challenges in the near term. Risks also remain from slower growth from an already low base, particularly if global demand falters further and supply constraints are not removed. China ongoing rebalancing toward more sustainable growth is also welcome, while vigilance is necessary with regard to challenges that might arise. And the impact of weakness in commodity prices globally remains a concern, particularly for exporters, many who are low-income countries. On policy actions, in emerging markets and developing countries, we agreed to use available policy space to smooth adjustment to less favorable conditions. In advanced countries, we agreed to maintain an accommodative monetary stance where appropriate, while being mindful of stability risks.